Hello, my name is Greg Bittar, CEO of Lotus Resources, an Australian stock exchange listed company with 2 uranium projects in Africa, one a near-term production project in Malawi called Kayelekera, and the second greenfields project in Botswana, Lekane.
Greg, lovely to meet you. We've not met or spoken before. We've been talking with Keith previously. Obviously, you've come in now as CEO, is that right?
As CEO, yes.
Right. So what's the mandate? What have you been brought in to do?
The mandate is to bring Kayelekera, our restart project in Malawi, into production as quickly as practically possible, to deliver and to meet the need that we see out there from discussions with offtake partners and the market generally.
Right, okay. Tell me a little bit about your background. Obviously, we've seen a bit of money come in recently, which helps, but what experience have you got, one in terms of running the company, and two in terms of kind of delivering projects like this?
So experience in variety of commercial, financial roles, a lot of time in the emerging, developing resource sector in Australia, from board through to executive management roles, through to consulting roles, in the gold space, across base metals and bulk commodities.
Right, okay. And with regards to specifically the delivery, because now it's about the delivery, right? You've got to show that you can get this thing over the line within the time frame that you've been guiding market. So maybe remind people what you've got in terms of the project, and then we'll kind of get into how you're going to deliver it.
So the project was acquired by Lotus in 2020. It was previously in production under its former ownership, Paladin. So it was Paladin's second project, commissioned in 2009, in production through to 2014. It produced about 10 million pounds. Obviously, the environment was very different back then. Fukushima hit, Paladin was uncontracted, and hence both projects were put on care and maintenance by virtue of the uranium price at the time. Lotus, when it acquired this project in 2020, set about completing and announcing a DFS in 2022. Again, the price environment wasn't quite right for restarting production at Kayelekera. But then through this year, we completed a FEED study, which allowed us to really firm up engineering and design work and position for a restart. I became involved in May with the company, became CEO a couple of months ago with a mandate to expedite production, and hence we've been able to announce an accelerated restart plan with production third quarter 2025.
I was fascinated by the operations of companies and business plans of companies. So the securing of the capital last month, the end of last month, very recently, indeed, were you involved with that?
Yes, yep. So that was launched on the back of our announcement that presented the accelerated restart plan. It talked about a reduced upfront capital amount and delinking anything that was longer term but required to optimise production, but anything that wasn't required to restart this brownfield site, we've taken off the critical path and focused on what does it take to restart processing at Kayelekera.
Right. Obviously, there's a low capex project. Very low capex project. Can just for the audience, maybe perhaps new to this, can you talk about what it is this project is fettered to deliver in terms of pounds in the market? When will it kick off? And how long could that run for?
Yeah, look, low capex because of the invested capital that the previous owner deployed, circa $200 million US, so much higher replacement value today. It has been on care and maintenance, although many aspects of the plant are operated each year. For example, water treatment needs to occur at the end of the wet season to treat the contaminated water in the ponds and discharge that into the river system. So some of the leach tanks are operated, a lot of the control systems, a lot of the pumps. So this plant has been on care and maintenance, but many aspects of it are in working order. We are looking to produce 20 million pounds from the current resource, and that will give us 7 years at approximately 2.4 million pounds. And then the tail end post year 8, or from year 8, we'll stop mining and we'll be processing some of the lower grade material to take us up to a total production of about 20 million pounds based on the current reserve.
Right, and you raised Aussie 130 million bucks, so a lot more than the kind of capex requirement. Why is that? And what is that allocation of capital going to look like?
So the capital requirement to restart is 50 million US, but then there is a whole series of capital items that are still being deployed to optimise and to optimise the operating cost structure. An important piece is a grid connection. So whilst Paladin, the previous owner, ran it on diesel gensets, we will start on the diesel gensets and have that there as full redundancy, but we want to connect to the grid. That's a 45-kilometre high voltage power line with transformer and substation upgrade requirements. So that's additional capital. We will be refurbishing the acid plant that comes on subsequent to production, and so there are capital items totaling another 40 million US that go beyond the restart capital of 50 million. So we seemingly raised a lot more than the 50 million, but we do recognise that there is more capital to be deployed, and there is working capital and other pre-production costs on top of the capital deployment. So I think we're comfortably funded for what we're looking to do at Kayelekera. We've got the second tranche of that placement still to be completed when shareholders are asked to approve it. The notice of meeting went out today, so the shareholder meeting will be on the 6th of December, and we're currently offering all shareholders an opportunity to participate through a small SPP, which is open at the moment.
Right, and obviously today's prices, I think your economic studies suggest that you'll be making a lot of money, which is great, but as investors will also be very comfortable margin, long may it continue. But people will be looking at this kind of 7-year life of mine and how you are eking out and optimizing through engineering and other things that this whole asset, this whole project. You talk about sort of shutting down and kind of and processing. Is there no opportunity to continue with the exploration and maybe see if there's more to be had underground?
Matthew, there is. Well, our focus is to get into production, get cash flow coming, and we will very quickly turn our minds to the near mine exploration opportunity, plus some additional tenements that Lotus purchased subsequent to the project acquisition. Small-scale resources already been declared on one of them, and that really was a small drilling campaign based on some aerial survey work to target, and that validate all that drilling was designed to do some time ago was to validate the targeting tools, and now we will, once we're well set on the path to production at Kayelekera, we will be pushing both near mine opportunities and these separated deposits, still within a reasonable trucking distance. I think the furthest one is about 90 kilometres, where there is demonstrated resource. There is also the opportunity around finessing with the metallurgy. Some of the limitations relate to the geological structures that we're dealing with, so the higher grade Arkose materials versus the mudstone. A lot of uranium in the mudstone, but we can only feed that through at a very modest rate to allow to not impact the throughput of the plant. So if we can finesse the way we deal with the mudstone and improve that will also improve the ultimate production volumes as well. So good opportunities at Kayelekera. We don't want to turn our back on that invested capital in that plant, and then we will use the cash flow from Kayelekera to focus on the development and support the development of our Greenfields project in Botswana, which we can talk a little bit about later on.
Well, love to. Okay, so I'm getting the message loud and clear. The focus is get into production. That's what the market wants to see. And time the market there, and you'll come back to the economic expansion and life of mine potential at the right moment.
Absolutely.
Okay,
yeah.
Got it. 100% makes sense. And let's talk about that kind of future potential in terms of maybe switching that kind of old model of pounds in the ground being valuable to actually production in a market like this and taking advantage of that. Obviously, Lethathkani in Botswana is a recent-ish purchase. It's a little bit further further back in terms of where it sits. What are you doing with that at the moment, or is this another case of you'll get to it when the time is right?
No, we think the time is right now. We need to spend we need to spend time and do the work on Letlhakane, but we picked it up through a merger with another Australian stock exchange listed company completed earlier in the year. That group, ACAP, had done a technical study. I wouldn't call it a feasibility study, a technical study around 2015. Different environment then. A number of assumptions for that technical study are no longer valid. So we've set about recutting and repositioning what we see as the Letlhakane opportunity. We've gone through a drill program, which was an infill program aimed at demonstrating the continuity and the grade and confirming that. And we've been putting out results to that effect, and that's pleasingly demonstrated exactly that, the continuity and grade. We've got one more set of results to come in fairly short order from that program. That drill program will then allow us to upgrade the resource to more of the categorisation of the resource as opposed to the size of the resource. We are doing a lot of metallurgical test work around the heap leach and the acid consumption. We need to think about the mining. This is open pit, but quite deep as you move across to the western side. And we need to think about cut-off grades and throughput grades as we balance out the acid consumption of this heap leach. So at the moment, ACAP, and we've taken on board the heap leach construct, large scale with a big mining operation. We think there is good merit in assessing the ISR potential, particularly as you move to the west to the deeper, more continuous, thicker seamed, lower grade areas of the deposit, and that's going to take us time. But one construct we are very keen to do the work on is ISR sitting alongside a reduced sized heap leach operation, utilising the one plant. But I think, Matthew, we need to spend the next 6 to 9 months doing the work, and hopefully through the middle of next year we'll be able to outline to the market what we see as the feasibility pathway for the Botswana project. Whichever way we cut it, we're confident, certainly as you look forward and you think about a more attractive or an increasingly attractive uranium price environment, we think we will have Letlhakane coming into production within the life of the current reserve at Kayelekera, being funded by Kayelekera, and setting us up for the longer term and a step up in annual production. That's the strategic objective.
Right. And can I, sort of coming back to a little bit about your brief and maybe your brief for the rest of the team. Obviously, kind of Keith's moved to sort of a technical role. You've got Michael DaCosta in there as well, obviously as COO. Is it a case of they know what they're doing and you're the kind of market-facing component, or is there a little bit of, hey, here's what the market wants, guys. I've just raised some money off the back of the following expectations, don't let me down? Because you're talking about getting into production next year. I mean, pretty darn quick.
Yeah, very darn quick. And I think it's a combination. I think it's a little bit of both, Matthew, actually. What story did we need to tell? What story could respond and allow us to address the pressures that we're feeling from the government now, having signed the mine development agreement in July, which locked in our fiscal regime, to position us as strongly as we can with our offtake discussions, which have been focused on North American utilities. And the closer, the more visible you are to production, the more meaningful those offtake discussions become. And we've had terrific traction with the two that we've announced. We've got others that we are hoping to finalise very soon as part of our initial tranche of offtake. But the fact that we can now talk more definitively about a timetable of production allows us to extend those discussions both with the existing relationships and new relationships, and the equity markets wanted to see some progress. We lost. You lose the benefit of these restart projects if you don't at some point get your hands dirty and work out what works. And there's only so much you can do at a desktop level. so much you assume around what needs to be replaced and what doesn't need to be replaced. And the quicker you get a construction and refurbishment crew on site with the right technical expertise, as we've done now over the last few months, the quicker you learn and understand what you're dealing with.
Right, and obviously you referenced, how things are advancing on the ground with regards to grid connections, and obviously you've kind of got a contractor cracking on with things there. Are you sort of still seeing inflationary pressures in the market when it comes to pricing, or was all that kind of fixed in?
No, look, part of the step change in the cost base from the DFS in 2022 to the numbers we released a short while ago with our accelerated plan, we did see a movement in both the C1 and obviously then the all-in sustaining cost. The all-in sustaining cost movement, apart from the C1, really related to the royalty movement in the mine development agreement. But the real essence of the change was inflationary pressures, plus what we've seen from running the mining contract tender process. The DFS assumed $1 per gross tonne. We've now got a real price for that as we finalise our discussions with our preferred mining contractors and we get close to appointing one of them. And that firm price represents a significant, well beyond inflation, step up from the DFS price. That's inflation, and we've locked that in. We've locked in the power tariff when the grid connection comes online, so we've updated that assumption. And the other, apart from general inflation, the other point that we're now seeing and can quantify is the cost of expat labour with our construction crews and our recruiting. Now that we've got an expat labour force on site, we know what that costs. And whilst that's an important part of restart, it'll be a very important part of maintenance, ramping up and maintenance. We will then be trying to deliver those skills to the local personnel and over time recalibrate the balance of expat and local workers. But the reality is, at first, we have a heavy dependence on expat labour, and that's a big part of the cost structure. So we've seen the price inflation. We're locking in as much as we can, and the learnings are giving us a lot of confidence around those C1 and all-in sustaining cost numbers.
Okay, that's interesting. And you mentioned Paladin earlier, and the first thing I think of when I think of Paladin, and you did indeed reference the fact that they were not contracted, and that's partly part of the reason for their downfall last cycle. Is what are your thoughts on risk mitigation, hedging, term contracting as in terms of the mix going forward for you guys?
Keeping an eye on the cost side and minimising that. But yeah, we are a relatively small scale operation. Malawi and its remoteness, there'll be costs that we cannot avoid. So I think we're well positioned with the current uranium price environment, but we were very keen to demonstrate through contracts that utilities and customers were prepared to take our material, were prepared to support our re-entry into the market with Kayelekera, and hence we set about putting in place an initial tranche of fixed price contracts. We said we would look to run that tranche up to about 30% of production for 4 years, and the contracts that we've announced so far are 2 of them, and they represent about £1.5 million between 2026 and 2029, or the first 4 years of production. That 2026 was set before the accelerated restart plan. So we'll talk to those counterparties about potentially delivering some of that later in 2025 now. That we've got a number of other discussions with North American utilities that will go into that tranche as well, looking to double the size of that tranche to about £3 million for those first 4 years, fixed price contracts, set off the long-term UxC trade tech price. Obviously, we gave them a relatively modest discount to attract, to allow them to demonstrate the economics of taking small contracts or small pounds from a soon-to-be producer. But we needed to do that because we couldn't participate successfully in the RFP processes. We just couldn't compete with the requirements of a cookie-cutter RFP process. We couldn't provide letters of credit. we needed certain flexibility around delivering first-year volumes. And so the bespoke unilateral negotiations have allowed us to actually build in some flexibility, and that came at a slight discount to the long-term price for this initial round of contracts. That allowed us to cover a higher proportion of our C1 costs.
Yeah.
And with the equity raise, now we can step back from being as prescriptive or being as boxed in around any senior debt that required significant offtake, significant contract coverage. And so that gives us that flexibility. And now we'll go back to the same counterparties and broader counterparties and think more about market-linked contracts. So we might take a slightly lower floor, but we'll give shareholders much greater upside to uranium price. So we will layer those in sensibly, but we're not now driven by a debt process timetable and the imperative to do that. We can be a little bit more patient, but I do want to see some of those market-linked contracts come into the hedge book, come into the contract book as we get closer to production.
Perfect. You went where I wanted to go, which is what the book looks like now and what the book looks like when you're in production and the type of conversations that you can have. There's a slight sort of power shift in the sense it becomes a bit more of a seller's conversation rather than a buyer's conversation. Interesting.
Or they take you seriously as a seller.
Absolutely. It's very, very different from we need this contract to get the funding we need at the price we need to be able to get this thing done to maybe supply it to you.
Absolutely.
Yeah, it's a very different conversation for sure. Okay, and tell me about what that could look like, because obviously you've got a couple of contracts in place now. We know what those look like, and we know what your intent is about trying to capture more of the upside with future contracts. But are you in? And I don't want you to comment on your current contracts because people utilities don't like that, but broadly you must be more, the nearer you are to production, the more attractive you are to other utilities. And I'm interested in the kind of mood out there, because for the last 5 years we've been talking about inventory levels with utilities across Europe, across the US, etc. And yet the utilities haven't really been moving. They've been moving quietly in the background. Is there a dawning realization from utilities that perhaps with Kazatomprom pounds moving east with delays and in terms of projects put into care and maintenance, Paladin obviously last month or so had issued perhaps difficulties around getting to production. The supply side isn't quite as advertised. So for you guys, does that help the conversations that you're having? Are more utilities lining up to or knocking at the door to have conversations about what could be?
Yeah, it certainly does help. And I think whilst you're not seeing it in the spot market and the vagaries of the spot market, there has been a shift that people in conversation will recognise in the term market, in the contract market. And so the collars and the floors and the ceilings that were able to be negotiated 6 or 8 months ago, we've seen, my perception is certainly from anecdotal evidence and from feedback we've had, that those collars have shifted dramatically north. And so the supply issue, the fact that we're only a small producer allows us to be slotted in more easily with the inventory management of the majors. It gives us flexibility if we were to give notice. If we needed the flexibility to pick up first year's volumes and drop them to second year, they can manage that. So the whole the rhetoric around supporting new suppliers some time ago has now become real, and the utilities seem to have become far more pragmatic and flexible, as evidenced by dealing one-on-one outside of the traditional sort of annual or semi-annual RFP processes. So there has been a shift across the board, pricing, terms, and engagement, looking to sign contracts with a small company like us and a small producer like us. it's quite comforting. It's quite exciting, actually.
I want to talk to you about Malawi before we kind of get on to maybe some broader thoughts about how the market's performing at the moment. We've seen a lot happening in Africa, up in Niger. Obviously, yep. you kind of got a tale of two cities in the sense that you've kind of got Global Atomic managing to move things along on the ground despite the kind of coup, and perhaps you've got GoVX who sort of struggled to deliver. It feels like, and I've worked in 25 countries in Africa. I do understand Africa a little bit more than most. If you're moving things along on the ground, you're going to get that support you need. If you are spending the money on the ground and moving and doing what you say you're going to do, if it feels like this is a good place to work, things move rapidly. The support from the Malawi government, what's that look like what has it looked like, and what does it look like going forward?
The support since we signed the MDA has been terrific. Probably too enthusiastic about when can they expect production to start. And we need to keep in mind that Malawi is an unknown mining jurisdiction. This was the major project. Small scale operations exist, but really there's nothing of huge significance in the country from a mining perspective. And mining is one of their three pillars of growth as they look to respond to the encouragement of the IMF, the World Bank, and the US to encourage and generate their own income. So mining is one of those pillars alongside agriculture and tourism. Tobacco was traditionally one of its strongest industries. It's been on the decline. One of the data points is that industry delivered between 300 and 350 million US of national income over 10 years. Well, if you look at the government direct interest in our project, which is 15%, if you look at the royalty regime, if you look at corporate tax, we have the potential, even in the current uranium price environment, to replicate that sort of national income, as well as the regional employment opportunities, as well as all of the indirect benefits that come from the services and the procurement in country. So we've terrific support from all of the departments, and particularly from a group called the Presidential Delivery Unit, which is part of the Office of the President, responsible for helping people, a whole range of things, but principally they work across all of the ministries and all of the departments to ensure that we're achieving our objectives and that the government and the people of Malawi are benefiting. So terrific support, and terrific support from an interest from the US Embassy in country. We've had people and groups contact and do due diligence with the US government about entering into arrangements with us in Malawi, and so it ticks all of those boxes. Commonwealth country, The Economist in 2020 rated it Africa's most stable democracy. They've got a presidential election next year, but we're well down the path now to restarting production with all of the government agreements in place and the support of all of the local communities. So we're very confident about being able to operate in Malawi.
And what are they doing for you economically in terms of? I ask this question in the context of, and I'm interested as you sort of ex-banker, effectively. Private businesses judged in a very different way from public businesses. Like if I'm private business, the bottom line is I got to make some money here. Public companies, they kind of get a bit of a kind of free run at it, and in the sense that we're buying into the potential of maybe could be. Once you get up and running as a public company, you need to kind of get back to basics, get back to fundamentals. You need the kind of cost of the money to do the growth part of the story is really important to you. The ability to do business in country is going to be really important to you. So what does Malawi do for you as a business on the economics? How does it help?
So part of the MDA, so the Mine Development Agreement, the 10-year fiscal stability agreement, we secured an exemption from withholding tax for the repatriation of dividends. That was critical. There are a whole range of other concessions around excise exemptions, tariff exemptions, the free flowing of goods and services in and out. But we needed to ensure that from a free cash flow perspective, that could be redeployed either for shareholder capital management or into Lekane or other growth opportunities. So that was a key aspect to the mine development negotiation and outcome. We are perfectly aligned with the government because we also have a community development fund that's based on the revenue of the project, and we're in discussions with the local communities about how that will work and when those funds will start to flow. The grid connection, it comes off hydropower, but it allows villages along the connection to benefit from access to a power grid. The employment and training. There's a whole range of things that we do in return, aside from the government's direct interest in the direct national income. But from a flexibility and capital management perspective, that was critical. Us being able to repatriate surplus cash flow without additional taxes.
It's something that investors sometimes forget in terms of that, the effect of what that does to the bottom line, what that does to the kind of cost of capital, what it allows you to do in terms of allocating that cash to growth parts of the story. Okay, interesting. With regards to the broader market, if you don't mind, I wouldn't mind your thoughts on what you're seeing, what you're hearing out there. Obviously, you've been able to move things along. You've been able to raise money. You have not been hampered by this kind of pregnant pause we're experiencing with the kind of equity prices, because you've been on quite the run. Like you come off a little bit like everyone else at the moment. Your thoughts on how this market muddles through? Are we going to be seeing some massive step change, breakthrough moment, catalyst, which is going to drive it all, or is it more accretive in nature?
Yeah, look, Matthew, you've probably heard a whole range of views on this topic. So mine can just go into the mix. But certainly if you look at the news over the last 6, 8, 12 weeks, it does feel like there is a momentum around clean power, demand in relation to AI, the large tech companies, the reinstitution or the recommissioning of dormant power supply, license renewals, incremental upgrades. I think there's a whole range of factors with more to come from that tech space. So you're not seeing the downward movement in forecast demand from North America. You have that sort of lifting up or flattening. You probably won't see too many traditional new nuclear power stations come on in the US after the most recent one, but I think one or two that were planned to be decommissioned. I think you'll expect to hear about their life extensions, so maybe some capacity upgrades. But this whole SMR phenomenon, I think even 12 months ago or 18 months ago, people probably were quite happy to say, well, that's probably not on the never, but is that 10 years, 15 years away? When does a commercial prototype become available? There's 5 or 6 now that are well advanced, but I don't think that's next year. But certainly you could envisage a world with the money, both from the US government and some of the recently announced initiatives and the giants that we're seeing involved in the space, at both the supplier and demand and customer end. You can sort of see that coming to fruition in the next 5 or 10 years, as opposed to it being, a lower probability and much further out. And none of that demand seems to be included in the traditional supply and demand analysis. You're then seeing the Europeans and the way the French and the UK, through the French operatorship, are looking to expand their nuclear footprints and rely more heavily on that. China growth continues. So there's a whole range of factors at a macro level that without any meaningful supply response, certainly in the next 4 or 5 years, but even when there is meaningful supply response, that traditionally comes at a longer time, at different levels than everybody hopes, and you've still got this market growing. So we're feeling very confident about it. We're feeling very confident about being able to lock in some attractive market-linked prices that give us significant upside, and then where that goes to beyond that, it'll be an interesting few years.
Well, it's interesting to you, but it's also a very interesting day.
Yeah,
There's a small
that's
election
right.
going on. I don't know if you noticed.
Has,
In the background.
has he come up on the stage yet?
He's been on the stage. He's claimed
That's it.
victory, but he's still short. As we speak,
Yeah,
he's still short.
still short.
But Nick, I think what interested me was, as a banker, for me, we pretty much didn't do anything for 6 months prior to the election. So we want to know who was going to win. We want to know, therefore, how to play the markets. We need to create products with which we could play the markets, depending on what the leader of the free world was going to say. How do you think, and you managed to raise your money despite that, I think that's a kind of impressive bit for me, and then the reason why it's impressive to me. How do you think Trump getting into power is going to affect the kind of nuclear dialogue in the US, and I guess more broadly?
Look, I think what we did see bipartisan agreement on the US recently was probably the only aspect or the only issue that achieved that was around nuclear power and the regulatory environment and the support for that. So that sort of de-risked the election outcome a little bit from the sector's point of view. Whoever you talk to in the US, and not that it didn't worry them who was elected. More there was bipartisan support for nuclear and associated investment. I think you're going to at the margin you're going to have a more attractive, more incentivized big tech investment approach. So I don't think. I think that was continuing, and the momentum's there, and we'll see more of the deals that we've seen from Google, Amazon, Oracle, and Microsoft. But assuming that Trump does take over, I don't think that changes. As a matter of fact, at the margin, it might improve that from a regulatory perspective, the bureaucratic perspective. I mean, I guess the interesting one for me is what happens globally around the conflicts. We saw the impact of Russia and Ukraine, and then the Russian sanctions. Does all of a sudden, does he solve that and or change the dynamic between world leaders, and what does that mean for uranium import bans from a mining perspective, but also down the chain from a conversion and enrichment perspective? So interesting times. I don't see, but the overlay there is China continues to grow. We've seen Kazatomprom and a huge percentage of that going to the Far East, and I don't think anything can change on a supply level. It's really going to stymie what we're seeing in terms of demand outlook, and hence the potential for the price environment.
Yeah, and also I think that's there's a good points, and it also feels to me, in terms of the narrative out there in the markets by various governments, that the industry has got on with the business of building the demand, i.e. new reactors, new SMRs, micro reactors. There's and all the derivatives off the side of that, energy and capital efficiency around energy is really, really important. It will be interesting, and in a way, it kind of immune to economic risk more broadly in terms of the industry. Equities, however, it'll be interesting to see how the equities respond to a new Republican government, for sure. I mean, what are your thoughts?
I presume that futures are up quite strongly as in the US.
Yeah, it's making moves.
It's making moves. Look, I suspect the bond markets were pointing towards or factoring more likely Trump victory in recent times, given where the yield curve was moving to, and that's probably a bit more of an inflationary push, and hence interest rates are around. Higher interest rates are around for a little bit longer, but yeah, that's at the margin. If you looked at both profiles of government spending over there, it still looked like they're heading pretty dramatically to spiralling deficits and debt. So obviously Trump pro business, pro markets are good for equities, hopefully.
Let's hope so. Fascinating times indeed, and nice to be part of it. Greg, lovely to meet you. And great to hear things are moving forward apace. Stay in touch and let us know how you're getting on, okay?
Will do. Thanks, Matthew. Thanks all.